So we talked about the consolidation in the year of acquisition if the parent uses the equity method. What happens when the parent uses a different method? So let's look at if the parent is using the initial value method, what should we do? First, let's think about if the parent has been using the initial value method, what is the difference? What differs on the parent's book? So on the parent book, what are we doing differently? Yeah, so if the parent has been using the initial value method, the parent is not recording the subsidiary's income or subsidiary's dividend or amortization. None of those would impact the parent's we have the 5 consolidation entries here. Consolidation entry S, A, and E, those will be exactly the same as what we do under the equity if the parent has been using the equity method. And the difference here is for consolidation entry I and D. And if the parent has been using the initial value method, there will not be the consolidation entry D. Or in other words, consolidation entry D is combined into consolidation entry I. If you think about it, if the subsidiary declares dividend, the parent is recognizing as its income. So instead of recognizing subsidiary's income as its income, the parent now is recognizing subsidiary's dividend payment as its income. So actually this I and D, those are just combined into one. And then for consolidation entry I, instead of use it to eliminate subsidiaries income recognized by the parent, or in other words, parent's equity subsidiary income account. We use it to eliminate parent's dividend income account, right? So now if the parent has been using the initial value method, there will not be any equity subsidiary income account. Instead, the parent is going to have a dividend income account, and then we use it to eliminate the parent's dividend income account, and at the same time eliminate subsidiary's dividend declared. So this is the general difference between the two. And then let's just continue to look at this example. If the parent used the initial value method in the year of acquisition, how would the consolidated total numbers be? So let's look at the second page of the worksheet. This second page it is in the year of acquisition, and then if the parent uses the initial value method. So first, just give you a reminder that this first column, as I said, it is taken from one of the columns we worked through in the last class. Specifically, if the parent used the initial value method, 40,000 dividend income, this is the dividend paid by the subsidiary to the parent. And then the parent investment account will be 800,000. So this 800,000 will just be the initial investment. Let's first look at consolidation entry S. S is to eliminate subsidiaries shareholders equity account. So subsidiaries 200,000 common stock, additional paid-in capital 20,000. To eliminate those, we debit those two numbers. And beginning stockholders, beginning retained earnings 380,000. To eliminate it, we debit 380,000. And accordingly, we credit 600,000 for the parent's investment account. So this is consolidation entry S. And A is the same as before as well. So we use it to mark up subsidiaries' book value to fair value and to recognize goodwill if there's any goodwill. Subsidiary has trademark, the difference is 20,000. Difference between fair and book value. Patented technology, difference is 130,000. Equipment has a difference of negative 30,000, and there are 80,000 goodwill, and we decrease the investment account by 200,000 accordingly. So A is the same as before. And for consolidation entry I, this is different. We use it to eliminate the dividend income recognized by the parent. So which is, in order to eliminate it, we debit 40,000 and we credit dividend declared by 40,000. So this journal entry, how do we get this journal entry? In the previous page, we talked about how to get this journal entry, consolidation entry D, right? And here, basically, we don't have D, and we're combining everything. We use consolidation I to take care of it. So for the dividend payment, if you think of what does the parent do, if the dividend has already been paid in cash from the subsidiary to the parent, how would the parent record this? What journal entry would parent record? It will record debit cash, right? Credit dividend income. And what would sub do? Sub would debit dividend declared credit cash, right? Suppose it has been paid out in cash. So we basically cash cancel out. And from the outside perspective, nothing happened. It's just this combined from paying to itself. So we need to reverse this journal entry. So the journal entry is to debit dividend income, credit dividend declared. And this is basically consolidation entry I. This is where I comes from. And for consolidation entry E, we just do the same. With patented technology 13,000 and equipment 6,000. So all of the consolidation entries has been recorded, and the last step is to add up everything to reach a consolidated total number. So here we just do what we did before. We add up almost everything horizontally first. So income statement, revenue adds up to 1,900,000. Cost of goods sold, 932,000. Amortization, 165,000. Depreciation expense, 110,000. Equity subsidiary earnings is 0. Dividend income is 0. And if you add them all up vertically, that will give you 693,000. This is carried over to your statement of retained earning. On your statement of retained earning, your beginning retained earning is 840,000. And then dividend declared is 120,000. If you add up everything in your statement of retained earning, that will give you ending retained earning of 1,413,000. This 1,413,000 is carried over to your balance sheet. On your balance sheet, current assets adds up to 1,440,000. Investment in the Sun company is 0. Trademark 820,000. Patented technology 775,000. Equipment is 446,000. Goodwill is 80,000. If you add up everything, your total asset will be 3,561,000. Your total liability adds up to 1,428,000. Common stock is 600,000. Additional paid-in capital 120,000. And everything adds up to 3,561,000. So here we do our normal check, right? Dividend income should go to 0. Your investment account should go to 0. Your total current assets should be equal to your total liability and shareholders' equity. And then here, if you compare your parents' net income with the consolidated net income, those two shouldn't be different. Those two should be different. So they shouldn't be the same. The only situation that they're the same are if the parent has been using the equity method. And there's one last thing I want to mention here. So dividend income, this 440,000, it is eliminated in the consolidation process by consolidation entry I. So that's why your dividend income will go to 0. How about your investment account? How did this number go to 0? So this 800,000, your initial investment is your net book value plus the difference between fair and book value plus goodwill, right? So your net book value is eliminated by consolidation entry S. And then the difference between fair and book value and the goodwill is eliminated by consolidation entry A. And nothing else impact your investment account. So after those two consolidation entries, your investment account is gone. So this is all I want to talk about regarding if the parent has been using the initial value method and in the year of acquisition, how do we do consolidation? And next, we're going to look at if the parent has been using the partial equity method.